A strategy with positive expected return can still go bankrupt. Expectation summarizes average outcomes across many paths. It says nothing about the path that crosses a capital boundary. A single large drawdown can end the strategy permanently. Once capital is exhausted, the expected return becomes irrelevant. Expectation does not prevent absorption. Capital survival requires more than a favorable average. A drawdown event is a loss that exceeds a critical threshold. Portfolio absorption occurs at a margin call or complete capital loss. Once absorbed, the strategy terminates. All future expected gains become irrelevant after that point. The tail of the drawdown distribution governs exposure to that boundary. Rare but extreme drawdowns dominate long-run ruin probability. The average drawdown does not characterize ruin risk. A leveraged trading strategy behaves like a finite random walk. Ruin occurs when capital reaches zero. Even a strategy with positive average return has a strictly positive ruin probability. Initial capital determines how long the strategy can survive adverse sequences. The Kelly criterion bounds the growth rate that avoids long-run ruin. Betting above the Kelly fraction increases ruin probability towards certainty. Capital survival is a question of path, not of expectation. Under a Gaussian model, extreme losses decay exponentially. Under a heavy-tailed distribution, extreme losses remain significant for much longer. Black Monday and flash crashes are not statistical outliers, they are heavy-tail events. Variance and standard deviation may be finite while ruin probability is not well characterized. Tail shape governs exposure to absorbing states, not average volatility. A finite backtest window cannot reveal long-run ruin probability. Over a finite horizon, ruin depends on the initial capital and the return distribution. Over an infinite horizon, any strategy operating below the Kelly threshold eventually ruins. Positive expected return reduces ruin probability. It does not eliminate it. Time increases exposure to capital-absorbing states. It does not provide protection. The Sharpe ratio and variance-based risk metrics measure symmetric dispersion around a mean. Ruin is an asymmetric event at a hard capital boundary. A high Sharpe ratio does not imply low ruin probability. Low volatility does not imply capital safety. In heavy-tailed return processes, variance may be finite, while ruin probability is structurally determined by the tail. Moment-based risk metrics are structurally blind to absorbing states. They measure dispersion, not survival.